Thanks again for tuning into Talking Point. I'm your host, Neeraj Shah, and now I hope we can do an uninterrupted conversation with Aditya Khemka of InCred AMC. Remember, I was telling the reason why we are doing this conversation, amongst other things, is that when you read the newsletter that Aditya and his team have sent out in the month of June, they're saying that if you worry about inflation, interest rates, as well as rising costs, the one space that can tide over all of this is a well-made healthcare portfolio. Now, I'll obviously play the devil's advocate and ask a lot of questions to Aditya about why does he think so. Try and counter some of his points as well. Let's try and see. Let's try and see what's the rationale behind Aditya's thoughts around the healthcare portfolio. Aditya, great having you. Thanks for joining in.
Thanks, Neeraj.
So, Aditya, can you start off with that? Why do you say that a well-made healthcare portfolio can tide over all of the three clear and present dangers?
Correct. So let's take inflation for an example, right? So first of all, when inflation goes up, why the equity investors generally worry is because input costs of corporates go up, and then they are worried whether the corporate will be able to pass it on to the consumers. And if they are not able to pass it on to the consumers, the margins will be affected, right? But if you see in our healthcare portfolio, we have about 50% weight in branded generics. Now, these are companies that primarily make their revenue and profits from selling products in India, and these are brands that they sell in India. So when you are selling a brand and you have brand equity with the doctor, with the patient, with the prescriber base, what you see is generally that the companies are able to pass on the cost increase to the customers because the customer isn't really worried about the price. He's not buying the product for the price. He's buying the product for the brand. So let's take an example of Crocin, right? So 10 years back, Crocin could be 15 rupees a strip. Today it is 35 rupees a strip. But if you were taking Crocin 10 years back when you had fever, you are still taking Crocin, for your fever. And it might have the cost might have changed from 15 to 35. The corporate margins are flat. They are actually making more margins than they were making earlier despite rising input cost. So that's one sort of example where these branded generics pass on the pricing pressure to the consumer because the brand protects the pricing. It's not a commodity market where if your brand is very highly priced and the other brand is low priced, the lower priced brand will sell more. Take paracetamol for an example. Crocin is a 38 rupee, 37 rupee a strip tablet. And then there is a brand called Algina, similar 500 mg paracetamol tablet, 7 rupees a strip. Algina's market share is in decimals and Crocin is a market leader. Okay, so you can see that higher price doesn't mean lower volume, and lower price doesn't mean higher volume in this market. It's all about the brand equity, the longevity of the brand, and how much reputation they've gained. So we like branded generics because of that, because branded generics are able to pass on price increases to their consumers, and the brand basically sustains on its own. Take another example, which is hospitals. So in hospitals, they provide you services, and you're not there for the price of the service. You're there for the quality in the outcome of the service. So you want the best quality outcome. You want a quick recovery period. You want a very well taken care of procedure, right? And you are willing to pay for it, right? Majority of us are willing to pay for it. So this sector, sort of works around inflation, where they say that, okay, costs will always keep going up, but we are always, about the service, the product, the brand, and we will price the customer for that. Now comes the second variable, which is interest cost. Now, interest cost worries investors because, if you have companies which are highly levered, the financial cost goes up as interest goes up, your cash flow suffers, your balance sheet suffers. But our portfolio is, again, a portfolio where the net debt to equity is 0.02. Okay, so we have created a portfolio where companies actually have not got any leverage, or the companies which have leverage have very less amount of leverage. So on a weighted average basis, the portfolio is almost zero net debt to equity. So that again insulates the portfolio from any rising cost of debt. That it doesn't impact the portfolio. Then the third reason why equity investors are worried is demand destruction. Now, healthcare historically, so last 10 years, your GDP growth rate for India, right up to FY21 from FY11, has been 5%. And the healthcare market growth rate has been between 7.5%. So that tells you that this is not a sector that is in any way exposed to discretionary consumption. This is completely involuntary consumption. So India, we are currently in the healthcare stage, not at a stage where we do non-discretionary procedures. So we do discretionary procedures. A majority of our market is actually non-discretionary procedure. We go to a doctor only when we are ill. We don't go to a doctor when we are all well, just to ask the doctor, how do we not fall ill, right? We go to the doctor only when we fall ill and say, what do we do now? So we are sort of a reactionary market right now, where we only go take care of ourselves when we are not well. And when we are well, we don't really think about, how to take care of ourselves better. So these are the reasons why we have created a portfolio where, these three factors won't affect the portfolio as much as it might affect some other portfolios.
Okay. Now I'm going to break this up, Aditya, because it's such a vast space. So it'll make it easy for me and everybody, and some of the people who are also listening to this right now or later on during the week or the month to understand. But just before I kind of classify all of that separately, just on your point one, Aditya, which is that, that branded generics will benefit of all the reasons that you mentioned. These reasons would have been true 12 months before, 24 months before, or for the last 5 years as well, right?
True.
But these companies are somehow not able to, I presume, quite display that kind of fervor in their numbers, despite the factors being there. So is there something that didn't work materially for the last 4 or 5 years? It may have worked in certain cases, it may have worked in certain time periods, but not as a, continuous process. And do you think that that can change over the course of the next 5 years?
Sure. So let me actually question your perception itself. I think people believe pharma hasn't worked in the last 4 or 5 years because people keep looking at the healthcare index. Now, the healthcare index, the top 60-70% of the weightage is in companies which are primarily focused on unbranded generics, which is the US and the European market. So the behavior of the index is actually determined by the behavior of this unbranded generic business model, right? Which is where we are saying that you can't pass on cost pressure because your product isn't differentiated. There is no pricing power there. You are basically at the mercy of the supply chain, at the mercy of the distribution channel. Okay. If you look at the companies other than the unbranded generics, so let me give you a data point. Over the last 10 years, the BSE Healthcare Index has given 430% return. This is point to point over 10 years. Over the last 10 years, Nifty return is 330%. So only if you had invested in a BSE Healthcare ETF, you would have outperformed Nifty by 100% over the last 10 years. Now, within the BSE Healthcare Index, there are two buckets. There is unbranded generics and there is everything else, which includes hospitals, branded generics, API, chemicals, all of that. Now, the unbranded generics in last 10 years is 2.7x, 270% in 10 years. This is where there is no pricing power in my view. The branded generics in last 10 years, it's 670%. Okay. And your weighted average comes to that 430, which is the BSE healthcare performance over the last 10 years. So when you say that in last 5 years, this fervor has not been displayed, you are saying so because you are focusing on the BSE healthcare index, which is driven by the unbranded generics because these are the larger companies. The smaller companies have actually done well over the last 5 years. Let me give you an example. 4 years earlier, let's say Ebitda Laboratories stock price was 350, 400. Today, like for like, stock price is still 1600, 1700. Indoco Remedies 3 years back was 120 rupees. Today, like for like, stock price is 360 rupees. So on and so forth. I can go on with the example. Sure. But the fact is that people don't notice these companies. People focus the performance of healthcare by judging the larger companies, and that's not where the investable space is today. Okay, great. So I'm glad you raised this point. So therefore, let me move to drug makers principally, right? In a conversation that we did about 12, 18 months ago, I don't remember the exact date, but at that point of time, you had very clearly explained, beautifully explained how, for example, the unbranded generics could well be classified as very cyclical plays, which in times of very good pricing power would do well. And at some point of time, that pricing power does come about. I heard you mention in your previous answer that it still doesn't look like a place to be in, and branded generics seems to be a place to be in. So can you now focus a bit on the drug makers and tell us a bit about what your thinking process is? Fantastic. So Neeraj, you are spot on. When we last spoke, I told you, and I've been saying this for a while now, the unbranded generic play is a commodity play because there is no differentiation in your product and the neighbor's product. It is just about pricing. Whoever wants to sell the cheapest can get the highest volume, but he will be the victim of the lowest margin because he's selling the cheapest. Right now, in a normal commodity play, the pricing and quantity is determined by a downward sloping supply curve and a downward sloping demand curve and an upward sloping supply curve. Wherever they intersect, the price and quantity basically is the equilibrium. Basic economics 101, right? Now, in healthcare, the demand curve isn't a downward sloping curve; it is actually a horizontal curve. Why? Because there is no price inelasticity. The volume is always given. The price still changes, but the volume is always a given. So, therefore, what determines price? It is supply. It is supply that determines price. If the supply in a given molecule is very high, you will never get good pricing in that molecule. If the supply in a molecule is very low, you will always get very good pricing. And it doesn't matter whether the molecule is a complex generic or an oral or an injectable or a derma ointment, it doesn't matter. If 10 people make an aeroplane will not get the right price. If two people make needle will get the right price. It is about demand supply, quantity-based demand supply, simple economic equation. Now, why do I say that it is still not the right time to invest in this space? I can still see more and more supply hitting the market. Demand has always been given, so I'm not even worried about demand. I don't even track about demand in this scenario because it's not relevant. It's a given number. You just have to supply. Just have to track supply. So you look at the companies in the Indian space only. I mean, why go outside India? There are people outside India, Bangladesh, China, Vietnam, which are doing this business also. But they're smaller players. We are the largest. Even within India, you look at the number of players who are putting more capacity to sell more products in US. That quantum of companies and the quantum of capex being done there is scary. It's absolutely flabbergasting as to why that is happening, right? But they are doing it, and because they are doing it, the supply will keep on coming to the market. And if the supply keeps on coming to the market, I don't see the pricing improving. See, we are not in a. So when you read research reports, Neeraj, they say that pricing last year declined in the US by double digit. We are optimistic of the US business because we see now price erosion stabilizing. Now, focus on the statement. Price erosion stabilizing means you still expect a 5% price erosion. Now, if you still expect a 5% price erosion, how is your margin going to recover? Your price needs to go up for the margin to recover. Now, price will go up only when the quantity contracts, the supply contracts. Now, the supply isn't contracting, it's still expanding. So if the supply is expanding, then you're not going to get good pricing. That's just not going to happen.
Okay. I was talking to multiple people and on Twitter and otherwise, and there seemed to be one train of thought that is coming that at every price or every stock, at some price, no matter how beautiful the business is unattractive, and no matter how gruesome the business might be, might turn attractive as well. So now my question is, and I'm sticking to the unbranded generics for a minute, and then we'll move on to the others, right?
Yes.
I was looking at the valuations, price to sales, or I mean, today, for example, the sell side has a double upgrade on Sun Pharma, but that notwithstanding, I was looking at the price to sales data. Sun Pharma 4.5, 5 times. Some of the others 3.5 times. I loop in about 1.8 times. TTM, of course, that's the only metric I can follow in such an uncertain world. So my question is, therefore, are some of those players which have a large global business starting to turn attractive from a valuation perspective, and therefore would you look at a trigger at some point of time in the future for them to become attractive buys as well, even if they are not right now?
I would, yes, and we do have a couple of unbranded generic companies in our PMS portfolio, and the reason for that is not valuation. I mean, valuation is a part of the equation. The reason for that is profitability of the commodity business. Now, what do I mean by that? What do I mean by that? So let's say company X, it can be Sun Pharma, Cipla, whatever. Company X is making 20% EBITDA margin in its commodity business. Company Y has a different commodity business, but is making minus 10% EBITDA in the commodity business. I would like to buy the company Y, which is minus 10% EBITDA. Now, why should I buy the company doing minus 10% EBITDA? If you're doing minus 10% EBITDA, and if you're a competent manufacturer, it basically implies that all your peers are also not making much money. But you are deeper pockets, you are one of the larger guys. So you have deeper pockets. So you'll be able to sustain that minus 10% EBITDA for a while. Whereas the fringe players, they will not be able to maintain that EBITDA. They will not be able to be in business for too long with that kind of an EBITDA margin. So they will crowd out. And when they crowd out, you are the guy who's left alone in the space and you increase prices. Again, that supply contracting, right? So which is why you never buy Tata Steel when they're doing 25% EBITDA margin. Right? That's the recipe for disaster. You buy Tata Steel when it's doing 2% EBITDA margin because from there it can go up. From 25, it just cannot go up any further, right? So be it Sun Pharma, be it Cipla, be it any other large generic company that comes to your mind, the best way to decipher whether it's now is the time to enter the stock, that is to look at the ROE and the EBITDA margin, because ROE is again a reflection of the EBITDA margin. So when Sun is doing 15% EBITDA, Lupin is doing 7% EBITDA, is Sun really that better a player compared to Lupin? That's the call you need to take. Or is just Lupin going through a rough patch and Sun going through a good patch in their commodity businesses? So if you buy a commodity business when it's going through a good patch, you'll probably lose money, because the commodity business will mean revert. And if you buy a business when it's doing bad in the commodity business, going through a rough patch in the commodity business, from there, again, mean reversion will be on the upside. So you will make money when the commodity business mean reverse to the normal profitability of the business. So that's how we evaluate these companies. We are not saying they're not investable. We are saying you invest at the right time.
Got it. The other piece, and I'm borrowing. So, Aditya, there are a bunch of queries that have come on Twitter. I'll try and take some of these during the course of this long interaction, right? So, Sajal Kapoor, Unseen Value, has said that, has asked to ask you. So his tweet is that, if possible, please ask Aditya views on the capital allocation discipline of the pharma players, which deploy sustainable, high-quality cash from high ROE India-centric business into a very cyclical and price-sensitive, negative ROC US generic business. If they demerge these businesses, could it, long story short, could it be value accretive, or will they not do it because then it kind of exposes the underbelly of the gruesome business that they have kind of, kept under wraps, so to say, over the years by virtue of being a consolidated business?
So just from a valuation standpoint, right? Just from a valuation standpoint, demerging the India business and the export business makes a lot of sense. It will create a lot of value because the India business is sustainable, high ROE, asset light, low working capital. Investors will get to see a complete different side of these pharma companies, which currently gets sort of hidden behind the overall balance sheet, because the overall balance sheet includes the export business, which is very asset heavy. Right, so they don't get to see the asset light business. So just from a valuation standpoint, it makes complete sense to do a demerger. The problem, however, happens is when you enter the real world, the business world, when you go outside the investing world and think about the business world, there are a lot of synergies in running these two businesses parallelly. Okay, now that synergy could be just in terms of R&D, product basket, regulatory affairs, IT infrastructure, HR infrastructure. There a lot of synergies in running this business together. And if you demerge, you can't run them together. Then you have to sort of, have two separate infrastructure supporting two different business lines. And that increases the cost. So I understand why many pharma companies don't demerge it. And I also appreciate the investors' concern that if they demerged it, there will be a lot of money to be made. Think of it this way, Neeraj. Pick any MNC pharma company. Let's say Abbott India as an example, right? Abbott India trades at 35-40p multiple as we speak today. Okay, and your let's say Lupin trades at 20p multiple today. Right now, and Abbott India has a smaller business than Lupin in India. It has a higher consolidated market cap today, right? And it does not have an export business where Lupin does like 10,000 crores of sales in exports. Abbott India doesn't have that business at all. Why is Abbott India given that higher multiple? It is given that higher multiple because whatever money they make from the India business, they put it on the balance sheet, and it goes into some current investments where they make whatever 3.5%, 4% return. Whereas when Lupin is currently doing that India business, whatever cash flow they are getting, they're investing it in exports. Where in exports they are currently making negative returns because they're loss making in exports. That is our assessment. Lupin doesn't say that. I mean, they don't disclose that segmental profitability. It is our assessment. So in our assessment, they're not making profits in exports today. So because they're not making cash flows or exports profit today, the deposit which Abbott makes, they get 3.5% return. The deposit, the money that Lupin gets, they make negative ROE on that, from the India business cash flow. Now, my point is the day Lupin starts making 3.5-4% return on the export business, which is only 3.5-4% ROE on the export business, which is a very, very nominal expectation to have as an investor. The day Lupin starts doing that, when you compare Abbott and Lupin, you will see clear value in Lupin and you will not see value in Abbott, probably at that stage. Whereas if I were Lupin's owners or the management, I would actually want a minimum 15% ROE because that is the cost of my capital, even from the export business, right? So I'm sure that they're continuing the business, they're doing the business. I'm sure at some point they do see that 15% ROE coming. The variable is obviously time, whether it comes in 1 year, 2 years, 3 years, they know, we don't know. Maybe they also don't know because there are so many market factors that impact the business. But end of the day, the fact is that if you don't have very high expectations, so my expectation isn't that export business should do 15% ROE. My expectation is that export business should do 5% ROE. If they do more 5 or more, I get better than Abbott returns on a stock, which is relatively half the multiple of Abbott. So,
got it.
So that just makes a lot of sense to invest in stocks like that at times like these. Obviously, there is a lot of fear, there's a lot of skepticism around the business model, but that's why the stock is where it is. And that's when you buy that stock, right? And you be patient with it. That's what you do.
Yeah. So I was going to ask you, in this patience, I presume, is also imbibed a point that you don't know the exact point from where the returns could come in. There is also a bit of a hope and a patient game involved that at some point of time in the next 6 to 12 to 18 months, the cycle could turn and you could make money. So don't allocate too much money, I presume, to such stocks. A little, and if the delta plays out, then you will gain a lot. if it doesn't play out, you don't lose too much.
Exactly. So because your margin of safety is high, your downside is limited, right? And you have to be patient. So yes, it can happen in 6 months, it can happen in 12, it can happen in 24. So you have to be patient with your money. And the fact is that you see, again, you are buying a company at the bottom of the commodity cycle for the company, right? So at some point it will have to turn. It always mean reverts, right? So how it mean reverts, what will trigger the mean reversion, very difficult to guess. When it mean reverts, very difficult to guess. But take solace in the fact that you are buying a commodity business in the downturn and not in the upturn. See, the mistakes that investors made in 2015 was they were buying pharma in the commodity upturn.
Yeah.
So in any commodity business, when the profits are very high, you have to lower the multiple to compensate for the fact that profits are currently high and they will mean reverted. Similarly, when the commodity business is making losses or profits are very low, you have to increase the multiple. Unfortunately, what we have seen in the past decade, when the profits were very high in 2015, the multiple was even higher. And today, when the profits are lower, the multiple is even lower. So that is a recipe for disaster, and this is a recipe to make money. But again, in order to make money from this, patience is the key ingredient. You have to understand the business model. You have to be patient. You have to know that you are buying something which will turn around at some stage. It is difficult to guess when. That is what the key question always remains.
Got it. By the way, viewers, Aditya has not mentioned any company, but should you feel that he was talking about a Sun or a Lupin or a Reddy's or whatever, please understand that there was no company recommendation and their views may change at the drop of a hat or a change of an event. So please don't go out making buying or selling decisions on the basis of this interview. These are merely used for illustrative and explanatory purposes. Aditya, one final question on this. And that is, what multiple or what metric do you use when you are valuing these? Is it simple PE? Is it price to sales? Is it something else?
So again,
and why?
Pharma, yeah, sure. So pharma companies are conglomerates, at least the larger ones. They are conglomerates. So it's like valuing a Reliance Industries, right? So in a Reliance Industries, you have a Geo, you have a oil and gas, and then you have a retail. Now you can't value all the three businesses on the same metrics, because they are different businesses with different longevity and different terminal values, right? So similarly, in pharma, you have unbranded generics. Within a company, let's say like Lupin or a Sun, you will have an unbranded generic business, you will have a branded generic business, you will have an API business. Now, on the branded generic side, a PE or a Ebitda multiple is a very comfortable, multiple to use, because it's a profitable business and a very sustainable, ever-growing business. Growth rate can differ from 8 to 12% year to year, but it grows every year. So bottom line, that is a stable business which you can use a profit multiple to value. Then you have your API businesses or emerging market businesses, very similar to branded generics, where they're profitable and you can use a EBITDA or a price to sales or something like that, depending on your comfort and at what stage the business is in. A mature API business cannot be valued at price to sales. An emerging API business can be valued at API to sales, at price to sales. So that's how you value the leftover. Now, the unbranded generic business, which is the commodity business, has to be valued on price to book. Because any commodity business currently might be extremely profitable, but the history was not profitable and future may not be profitable. Similarly, currently may be loss-making, but the history might have been profitable and the future might be profitable. So like any other commodity stock, cement, steel, when you use price to book, that is the rationale, and that is the rationale you use. Now, the trick here is that these companies don't disclose the book value or the P&L of the branded, unbranded generic and all. So that is where our expertise comes in, and we sort of, take educated guesses. We also don't have those numbers from these companies, but we take educated guesses as to what the book size of the unbranded generic business is, where the branded generic profitability is, where the API profitability is. And then we do an SOTP. So we value the three segments separately and we do an SOTP. And that is when you arrive at the fair value of a pharma company.
Got it. Last question on these drug makers piece. So to say, actually, I also have API questions, but I'm just classifying them separately. But the branded generics business, you would reckon it's a hold to maturity for you?
Absolutely. I mean, the branded generic business for me is a FMCG business. What changes in that business? Nothing. See, the mortality. So branded generic business in India is actually extremely competitive. There are more people selling branded generics in India than there are people selling unbranded generics in US. And US is a $500 billion market and India is a $30 billion market. So that tells you something, right? It's an extremely competitive business. Why is it extremely competitive? Because it is extremely profitable at this point in time. Everybody wants to have that kind of profits. But why do people still not make that kind of money? A majority of these guys, there is a very high mortality rate. Why is there high mortality rate? It's a business with a gestation period of 8 to 10 years. You have to create a brand. See, in unbranded generics, somebody sold the product at $100, you are launching the product at $5, you are inheriting the market that they created. It's an inheritance because they created the brand equity of the product and the usage of the molecule. You are just launching it at a cheaper price and inheriting the market, right? In branded generic, you are not inheriting anything. You are creating a brand. So you have to invest on day one. Cash flows will come in year 7, year 8, year 10. And you have to have that kind of money to stick through that period to ensure that the brand grows to a level where it becomes profitable, right? Which is why branded generics, people who are successful, who have already crossed scales of 500,000 crore sales in branded generics, their balance sheets are better. Ours is the only sector where the largest company does 14% ROE. And the smaller companies, which is with a 500 crore top line, does 25% ROE. It doesn't happen in any other sector. The reason for that is the smallest company is only a branded generic company, and the largest company has unbranded, branded, API, a mixture of all of it.
Got it. Actually, I preempted one of the questions that came in. Dr. Vimal Agarwal has asked the 2 questions only, sir. One, what is your view on the proxy play on the onco infertility space, and what's your view on the domestic pharma? He's asked about a specific company which I'm avoiding.
Sure. So branded generics, as I said, I mean, this is a whole to death portfolio for me. I don't think I need to worry about that space for any reason because it's a branded equity play and they keep growing every year. Asset light, cash flow rich, very tight balance sheet, no need for fixed assets, very few working capital, problems. So that's clear. From the hospital side, again, very similar thesis to branded generics. People don't understand hospitals that well, I believe, as a business. But it is very similar to branded generics because again, it's the brand of the hospital that attracts patients. It's the brand of the doctor that attracts patient, and the doctor is loyal to the hospital. So it's a network between patient, doctor, and hospital. So a patient generally goes to a doctor, is loyal to a doctor. The doctor is generally loyal to a hospital, and that's how the hospital makes its money. And it's about services. So you give best-in-class services, and you charge the patient for the service, and the patient is happy to pay for the service. Many people actually want to compare hospitals to hotels, and they say, Aditya, both of them give room on rent now. So it's just it's a renting business. So I give them this response. I say, look, in a hotel, if you go, you decide how many nights you stay. When you go in a hospital, you don't decide how many nights you stay. In a hotel, when you go, you decide whether you buy from the gift shop or you eat at their restaurant. In a hospital, if you go, you have to buy from their gift shop and eat at their restaurant. And then thirdly, once you have gone to a hotel, you may not want to go to the same property again next time you're in the same city. You want to experience a different property. In a hospital, once you have gone there, you're always going back there only till the time you're alive, right? So you can't compare these two business models. There's absolutely no comparison. So yeah, I like the space. As far as oncology and super specialty goes, look, across the globe, super specialty companies are valued higher than multi-specialty companies. It is only in India at this stage that super specialty hospitals are actually cheaper available compared to multi-specialty hospitals. And that I don't know is happening probably because most of our investors don't appreciate super specialty and multi-specialty. They appreciate scale more. So we have multi-specialty hospitals which are larger and people appreciate scale. So they are buying the larger setups. But super specialty hospitals which are smaller, people don't appreciate the fact that they're super specialty. Their audience is extremely sticky, right? And because of that, and onco being a space where the incidence of the disease is just growing by leaps and bounds, I don't see any problems in stocks and companies like that.
You reckon the way investors are looking at that space could mean revert at some point of time or change in the way the world is looking at those companies outside India as well?
Absolutely. So actually, it has already started changing. So that one super specialty company that we are talking about was in double-digit stock price 3 years back. Today it is close to 300 odd. So it's already been 4-5 bagger over the last 3 years since we started looking at it. And clearly there is a multiple re-rating which has already happened, but clearly the multiple is still way behind where it needs to be because the multi-specialty hospitals are even more expensive. So the fact is that there's a lot of room to left for the these companies to do well. Another mistake generally that investors make is they focus too much on net profit and not on cash flow. So the company that we are discussing as a super specialty company, it has been positive cash flow for last 5 years. Net profit only came last year. But people were avoiding the stock because they were focusing on net profit and not on cash flows. We bought the stock 5 years or 3 years back because we were always focused on cash flow. And the company was always positive cash flow. So, so again, things that investors need to learn, in a business where there is a lot of asset, depreciation will be a big number. and it will weigh on your net profit. So you're better off looking at free cash flow, operating cash flow. And when you do that, you notice that the super specialty company's operating cash flow is actually more stable than that of, let's say, Sun Pharma.
How do they achieve scale over a period of time, Aditya?
So see, this is a business where scale is not the criteria. See, again, they can scale up by growing 15% every year. But if you want quicker scale, you want something that can grow at 40%, right? So a multi-specialty hospital can open multiple branches and maybe probably grow faster. But a super specialty or a branded generic or unbranded generic, if you want to take it in that context, if I have a brand in the market, my competitors also have a brand in the market, no? So my brand can't suddenly eat their brand equity overnight. True. So I will have to take my time to create my brand. That equity will come very, very slowly, gradually, but it will be extremely sticky. It is a high multiple business, right? In an unbranded generic, I can gain overnight market share by cutting the competitor price by 20%.
Sure.
But then I can lose that business the next night because somebody else cuts my price. So it is always a trade-off between stickiness and how soon you want the result. Instant gratification, right? So we live in a society and in an investor world where everything is quick today. You want everything today. So if you want everything today, you may get it, but you have to pay for it.
Yeah, sure.
And what you pay for it is you pay for it with returns. You sacrifice returns for the early sort of absorption of those returns. In the branded generic space, your returns will always be there. It will be very, very gradual. It will be very, very sticky, but it will always be there. In the unbranded generic space, there will be years when you make 40% return on a stock. Absolutely. Next year, the stock might be down 50%. You lose everything that you invested. So you have to understand what you pick and choose.
So in effect, you are saying that super specialty, for example, any company in that space over a period of time will have steady, sticky, slow returns on earnings and cash flows, and the multiple re-rating might add that little bit of alpha on top of the cherry on top, something like that.
So I'm not saying slow. I'm saying slow compared to the multi-specialty.
Slow, yeah, sure.
So a larger bouquet can always attract more footfalls. A smaller buffet will attract lesser footfalls. But if I'm a specialty Chinese authentic buffet, I'll attract fewer people. And if I'm an Indo-Chinese multi-cuisine restaurant, I'll attract a lot more customers. Sure. But those lot more customers will not pay me as much as the people who will go to the authentic Chinese buffet pay them for the authentic Chinese food, right? So it's sort of an analogy drawing on that side. So I'm looking at profitable growth. I'm not looking at insane top-line growth with no idea of where the profit and cash flow is going. Okay. So I'm looking at profitable growth. I want to look at companies that can maintain ROEs, that can improve ROEs. And I'm looking at companies that cash flow is very, very healthy and sticky. One point on this, Neeraj, other than FMCG, one of the very few businesses in India that has negative working capital is hospitals. So people don't appreciate what a negative working capital means. It means absolute bargaining power. Your customer is at your mercy and your vendor is at your mercy because you are able to ask your customer to pay sooner and you're able to pay your vendor later, which reflects by bargaining power in the business supply chain. So, to me, that's something that people need to pay more attention to.
Yeah, most certainly. In fact, the other thing that strikes to me, Aditya, in some cases at least, if not all, that the customers are not always in the bargaining mode. One, because they can't, and two, because there is a mediclaim paying for it in a lot of cases. Unlike a hotel wherein they have to pay out of their own pockets.
Absolutely.
Okay, let's move on. Since we are on this topic, I'll come to the API discussion later. But since we moved into hospitals, I want to kind of question you on diagnostics as well, right?
Sure.
Now, Aditya, I remember our conversation sometime back in the same webinar that we did, when you had told me about how these companies probably didn't even need to list themselves. Yes. Because they don't need the money, but they list it because they get free advertisements, etc. And it's a long growth path, etc. Right?
True.
But I think before the market meltdown started as well, these stocks have corrected quite significantly. So you can't necessarily blame the fact that the markets have come off, that the diagnostic companies in India have come off. They have come off before that.
You're right.
And there is some evidence, or while Saurabh Mukherjee might defy me and say that he doesn't see on-ground evidence and he's more learned, I haven't gone to the ground. But there is some evidence of some bit of competition steaming in, right? In the sense that the Adani Group has said that they are getting into this space. Tata 1mg's put out very low-priced tests, and in Bengaluru as a pilot. Maybe they'll expand as well. How do you look at this space at the current juncture? after all that's happened over the last 12 months?
So 2-3 parts to your question. I'll take my time in answering them because it's important to get the messaging across. First part to your question, where why did the diagnostic stock fall even before the market started falling? The reason for that is diagnostics actually benefited from COVID. So it is one of the very few subsectors in India that actually benefited from COVID because the volumes went up multifold because of the diagnostic tests around COVID and the antigen and the rapid tests that were happening, right? Now, again, investors in their own wisdom sort of decided to give that high one-off revenue stream and margin stream a very high multiple. And these stocks sort of gave you fantastic returns in the early legs of COVID. And now that the COVID business is down and basically COVID testing is down, these earnings have come down and the multiples have derated along with the earnings. Now, again, as rational investors, the logical sense would have been that if the earnings are going by leaps and bounds and it's non-sustainable, your multiple should have actually stayed low on the other side. Whereas while the diagnostic companies went up, the multiples actually went up because the COVID tests are happening more and more. Now, if you remember our last conversation, I told you I love the business model, but I don't own much of it. And the reason I didn't own much of it at that point in time was precisely this, because there was COVID tests happening and everybody, including me, knew that was not sustainable. But the multiples, rather than going down, had gone up. So we were very uncomfortable around the valuations of diagnostics at that point in time. Today, we are at a stage when the COVID testing numbers have come down, the sustainable business numbers are actually going up. So now the non-COVID business numbers are actually recovering as the society is normalizing. But because YOY or QOQ earnings are not looking good, because the QOQ or YOY numbers include COVID and the current quarter numbers don't include COVID, the stocks multiples have actually come off now, which is again contrary to fundamental understanding. When the business is now retracing to the only sustainable number, your multiple needs to go up rather than multiple needs to go down. So currently we are in a situation where the earnings is coming down and the multiple is coming down, which is why stock prices are reacting the way they are reacting. It's a one-way fall. And that always is an opportunity because, again, people are contracting multiple when the one-off business is going away. People should have contracted multiple when the one-off business came and increased multiple when the one-off business went away. Sure. Which is what gives you volatility in these stocks, because people, general investors, sort of appreciate the nuances of these business models. And that's where, now we are saying we are comfortable with diagnostic companies' valuations as well, because we believe the business model is extremely sticky. Now let's come to competition, right? So competition is something that has been very, very interesting subject of discussion over the past 5-6 months since Tata 1mg and everybody started advertising those low prices. So my one question is, okay, they started advertising low prices. Have you done a Tata 1mg test on yourself? And if you have done that,
it's a pilot market, right? They haven't expanded meaningfully as
absolutely. Yet. So one, they're doing a pilot, but Healthians was available even before Tata 1mg launched. Healthians Lab, the Healthians is sort of a laboratory, online laboratory platform. They were available even before Tata 1mg pilot came in, and Healthians is an all India platform. So you can get your 100 rupee test done at Healthians also. The fact is that it's not about the price of the test. Once you get the report, what do you do with the report? You go to a doctor, no? You show it to the doctor and say if everything's okay. And if the doctor sees the report and sees Healthians at top, he doesn't know who Healthians is and he doesn't know what laboratory that test was done in. What does he do with the number? See, you have to understand one very critical thing here, Neeraj. You as a consumer might be attracted by the price point. I get that and I understand that. But what is the utility? The price point is one part. The other part is utility. So once you get the report, you have to go to the doctor and the doctor has to advise you basis the report. Now, the moment the doctor advises you basis a diagnostic test, the responsibility of your treatment shifts from the diagnostic company to the doctor. The doctor later cannot blame that it was a wrong diagnostic report, therefore I gave a wrong medicine and something happened to the patient. So the doctor is not going to accept a Healthians report or something like that. I'm taking Healthians as an example. I mean,
sure, of course.
Yeah, I'm not saying Healthians is not acceptable. It is very acceptable maybe. But I'm just saying that the moment you get an online lab test report to the doctor, if he's trusting the report and is treating you, then the responsibility and the onus now lies on the doctor. So if you go to a majority of these hospitals, right, even if you carry outside hospital tests, right, tests from a Sunflower Laboratories or something, a Purnima Laboratories or whatever, if you take it to the hospital doctor, he will say, no, get this test done at my laboratory. Let's see your numbers and then maybe I'll give you a course or I'll give you a treatment, because he knows the laboratory inside the hospital and he knows that it is reliable. If he treats you on the basis of the test of an external laboratory, especially if it's not certified by NABL or something, which is a very quality of standard sort of stamp, then the doctor is taking a risk. So what we have seen is that these online labs and all, they have I mean, Healthians has been there for past 2-3 years. Tata 1mg is a new player. But we haven't seen any impact on the non-COVID business of these laboratories. So what is happening is it's a Lollapalooza effect. The non-COVID business recovering, the COVID business going down, and these online players coming is making the people believe that there is something wrong in the business model. We read something wrong, right? That's not the case. It is just what you are able to perceive versus what is actually happening. So what is actually happening is non-COVID business is recovering, because if non-COVID business were to be impacted by competition, it would have never recovered for these companies. The competition is already intense. Lupin has launched its own line of diagnostic labs. Mankind Pharma has launched its own line of diagnostic labs. Why there is a recovery in the non-COVID business of a Dr. Lal or a Metropolis or a Thyrocare? There shouldn't have been a recovery. No, that new business should have gone to these new players, but it hasn't gone to those guys. It has come to these guys only. So there's a reason for that, right? So it's a branded play. There is a quality attached to it. There is a perception attached to it, and there is acceptability attached to it. That acceptability is the key criteria. You can pay the lower price, but if the report is no use and the doctor asks you to get the test again, what use is the low price?
Got it. Okay. So in which case, what you are also suggesting the same thing as I was saying, that my conversation with Saurabh of Marcellus was that on ground evidence of this competitive pressures resulting in either pricing erosion or lower business is not evident.
It's not evident. No,
it's not evident. Okay. And if indeed the competition were to heat up, are you of the opinion that the market is just so large and so unorganized even now that it won't be a case of one eating others pie in the organized space? Everybody will benefit.
Absolutely. So diagnostic market is 85% mom and pop store still. So there is enough room and space for new organized players to come and sort of cannibalize the unorganized market share. They don't have to fight with the organized guys. They don't have to take the incumbents on.
And the numbers will start normalizing, if not immediately, then 12 months out, because then the larger portion of the non-COVID contribution will hopefully have passed away.
True. So your COVID contributions are already almost close to zero now. So now the numbers that you see are non-COVID numbers. So if the street wants to see growth on a consolidated basis, they will see it next year, because this year will be only non-COVID business and next year will be non-COVID business plus growth. So that's how the numbers will appear.
Okay. Great. So I don't want to get into names, Aditya, but one final question. You mentioned earlier that you were not comfortable then when the stock prices were what they were and the multiples were what they were. Are you getting comfortable now, or will you bide your time because the path to normalization is still, I mean, we're already in the normalization mode, but the numbers will start probably showing only 1 year later. So are you looking at diagnostic companies actively, or are you still biding your time?
No, so we are building a position there, and we will continue to build the position over the next 12 months. So we don't believe we are the smartest, but we do believe that if we are the most diligent, we can build a position before everybody else.
Well, humility and competence, it's a great recipe, Aditya. Let's move on to the other aspects on APIs. Now, that's a space that is owned by a lot of people, and which is where there's a lot of interest there.
Yes.
What's your sense? Because about the competitive intensity, both from China and how it is, and more importantly, in the current disrupted world, which is very difficult to predict when it will resolve itself.
Sure.
How does this space perform according to you?
So even before I respond to any questions, I think, again, API as a space is slightly misunderstood. I'd like to clarify how we look at the space. So we look at the space in two buckets. There is a branded API business where basically it is contract manufacturing for innovators or for branded players, right? And then there is a place for contract manufacturing for generics. When you make APIs, the API feeds into generic companies because they make the end formulation products on their own. We are bullish on this side, on the innovator business, the CDMO or the contract manufacturing business with innovators. We are not very bullish on the contract manufacturing for generics. Now, just like it is in the case of branded pharma, branded generics and unbranded generics, where some of these companies are conglomerates, most of these companies in APIs are also conglomerates. So they do both businesses. They do contract manufacturing for innovators and they do contract manufacturing for generics. And they report these two segments separately. So coming to, let's say, the overall outlook, the outlook on the contract manufacturing for innovators is fantastic. It has never been better. It is that good. The problem area is the contract manufacturing for generics. So this is where you are seeing a significant pressure. Obviously, because your customer is under pressure, your raw material input cost is going up. You are sort of caught in between. You can't really pass on the cost, and your cost is also escalating. But end of the day, if I am an API manufacturer who has a lion's share of profit and asset employed coming from the innovator side, I am pretty much insulated from what happens on the generic side. And if I am a player who's purely doing generics, then I have no play in the innovator side, and we as an AMC then have no interest in that name, because we don't want to buy that business, because we know the customers are under pressure. So we don't want to buy these guys. We want to buy these guys who have a lion's share and a lion asset employed base in the innovator supply side. So on that side now, what is happening is most of these APIs last year when there was COVID, you have to understand the customer's business model. Okay, so innovators, they create a new product and then they go out and market their product. So they create acceptability for their product, their molecule, right? Now, for them, the highest cost in their P&L is not R&D, it's customer acquisition cost. So the promotion to the doctor, the campaigns, the sales force cost, and all of that is their biggest cost, right? Now, the moment their product is accepted, it is their first primary responsibility to ensure that the product is available on the pharmacy shelf. Because the last thing you want to do is that the doctor is now writing a prescription, but the patient is not able to buy it because it's not available on the shelf. And therefore, the doctor switches the prescription to your competitor. That is like the draconian scenario. That is something that can get the CEO fired in a company like a Lilly or a Pfizer. Okay. So you never want that. Now, for these guys, therefore, what happened during COVID was they got really scared of stockouts, because there was no material of movement of material, there was no manufacturing, and they got really scared as to what will happen with the stocks. And the demand actually went up during COVID of certain molecules. The demand actually went up for treatment. So what these guys did was they ordered very high quantities of API to stock with themselves, so that they don't get a stock out on their end product. So they never want that situation. So therefore, all these companies were engaged in this business model to supplying to innovators. They had very high volume growth last year. Because that volume growth, so normally, let's say the innovator takes 100 kgs every year from you because his product is mature and he knows how much he's going to sell. Let's say he buys 100 kgs every year. Last year, the innovators has decided to buy 150 kgs. So you supplied 150 kgs, but now this year the innovator is buying only 70 kgs or 75 kgs because he already has stock of last year. So what happened again? Your 100 kg went to 150. The profit went up. The revenue went up because it's operating leverage all the way, and the stock prices soared because the multiple also went up. Now today that 150 is down to 75. Otherwise, normally it would have been 100. It's down to 75. So profit is declining, revenue is declining or flat, and then your multiple is shrinking, and the stock prices is falling like 60-70%. Right? Again, the same thing. When the numbers are artificially bloated, your multiple needs to be lower and not higher. When the numbers are artificially lower, your multiple needs to be higher and not lower. You have to understand this. And I think the street keeps doing this with every business. It's not particular to pharma. I've seen this across.
Sure.
So in the pink of health, in the peak of profitability, most of these businesses get the highest multiple, which just doesn't make any logical sense. As long as you believe in mean reversion.
Sure.
If there is no mean reversion, it's a different story. But this is a sector that for the past 20 years, and you have read the newsletter, we have shown there the mean reversion of margins. This sector for the past 20 years has been mean reverting in terms of margins. So, and ROEs for that matter. So you have to understand that you cannot give a low multiple to low profits and a high multiple to high profits. That's on both ends is a recipe for disaster. So we as a fund, when we were invested and all the stocks were flying high, we got the maximum inflows from investors. Okay, and we were not calling up these investors to invest. We just got a lot of flows. Right now, today the flows have absolutely dried up. So again, that's a problem that we face, and we really we want to educate investors more and more through these newsletters that you have to understand the nature of the business you're investing.
Get your point. Okay. So, Aditya, couple of questions, a lot of let me bring in the street questions directly, right?
Sure.
We've got about 10 more minutes left for this conversation. So, Vivek Nayak is asking about the China effect, past, present, and the future, more importantly, because if indeed there is some bit of a give and take between US and China and the US administration, his tweet is that the US administration decides to give China some concessions by reducing tariffs in order to control inflation. Will you change your view on the India API story?
So it's not about the administration or the tax. It's about the customer, right? So why were these customers earlier buying purely from China? Because the cost of was very different. It was China was supplying for something for $80 that India was able to supply for $100. And the fact is that Indian companies were making so much money in formulations, they were not even bothered about making APIs. In fact, they started sourcing their own API also from China because it was cheaper to source from China than making in-house, right? By the way, the US Home Department has also made a statement saying that depending on Chinese raw material for healthcare products is a national security risk. So they've made that statement. So basically, you know where the administration, but that's the administration. I'm not even going there. The key point is, as a customer, I was earlier buying from China because there was a huge cost arbitrage between buying from China and India. Today, because China has implemented pollution norms and they've tightened their belts on what carbon footprint this industry can leave, the cost has become, for certain molecules, for a majority of molecules, the cost is more or less at parity. Now the same customer is saying that earlier buying from China was okay because there was a huge gap. Today it is almost on parity. So is it still okay to buy from China? And if I have an alternate supplier, I'm de-risking. And COVID has not helped the case, right? So China has gone under lockdown multiple times, a zero COVID policy, right? So this is what is driving the customer away from China. And he's not saying that I'm not buying from China. He's saying I'm adding a vendor to China. So it's not that China is losing a favored nation status or something, right? It's just simply a risk management tool at the hands of the customer. Now, the fact is that China exports API worth $30 to $40 billion and India exports API worth $4 billion. We are 1/10 the size. Even if 10% of customers from China ship to India, we double. Right? It's a simple mathematical equation. So I don't see much risk to this. What I can tell you is it will not happen overnight. So creating capacity, getting order books, dossiers, regulations, this is a 2-3 year, 5-year thing. You are not going to get your returns in 2 months. So that is, I think, expectation is the problem there. So people expect to see 20% revenue growth next quarter. Sorry, boss, not going to happen. Okay, so this is a sector which takes time. It's sticky because it's very difficult to move. But once it moves, it sticks.
Got it.
That's why there is a expectation. Yeah.
That's interesting. Okay, so a bunch of other questions. Actually, I can't take all the questions that Soik Finance has asked, but they've asked a bunch of questions. So saying if the companies, I'll read out the tweets as it is. So saying if these companies, the API companies, cannot maintain their margins in a volatile environment, why should these be given a high valuation? Isn't the fragility too much on the supply side? And on the supply side, too many DMF filters?
Yeah. So see, the high valuation thing is a subjective thing, right? So is 20 PE high or is 40 PE high, right? For me, 100 PE to a Venue Supermart may be high. To someone else, 100 PE to a Venue Supermart is cheap. My simple point there is, I'm not saying high or low. I'm saying if you look at these APIs companies' margin trajectory over the last 10 years, you will see mean reversion in all of these companies. So you buy them. So you better buy them when the margins are below the mean rather than buying them when the margins were above the mean, right? So today we are in the game where we are buying these stocks when the margins are below the mean. And we just believe that the last 10 years, so history will repeat itself, right? So there again, mean revert. Either the cost will go down or they will increase prices. See, I want to retain my customers, so I can absorb some margin pressure. But if the margin keeps compressing, I don't want to be in business. No, end of the day, I'm a businessman. I want a minimum ROE on my capital employed. If I'm not making that, why do I do business at all? I would rather put my money in FD, no? Why should I bleed?
Right? Would the end consumers, which might also be going through some bit of pricing erosion, etc., still be able to absorb these higher pricing from API companies?
Absolutely. So so again, within the generic consumers, there are two types of generic consumers. Sun Pharma or a GSK might be buying that API from me because they're using that API in branded generics in India. There they have enough room to absorb. They will easily absorb. But if they are buying that generic API to make a ANDA for US and selling it in US, there the absorption is difficult. So then you're going to have to get deeper. You have to get your hands dirty. You have to understand your company's customer profile, and you have to play it accordingly. So if your company that you're investing in, the customer profile is more of the US and the European unbranded market, it's very unlikely that your company will be able to pass on because their customer won't be able to pass on. Whereas if your industry company has more innovator pharma customers and more branded generic customers, they will be able to absorb and pass on. So you will be able to pass on.
And in India, in the 4, 5, 6 companies in the listed space or otherwise, companies have exposures across unbranded, non-price sensitive, or price sensitive versus the others as well.
Absolutely. So you have the profit between these 3 segments, and then buy the ones where the top 2 segments, which is innovator supply and branded generic supply, is at least 70% or more.
Got it. Okay, Aditya, one more follow-up question on this, and then we'll let you go.
Sure.
But one more follow-up question is: do you think that in certain cases history may not repeat itself, in a sense that while normal mean revision would happen, but because of the factors that you mentioned, that Eli Lilly CEO could get fired if the stocking is not predicted properly, and in the current or in the future, now from here on until the next 3 years, because you don't know what Chinese policy will be, then they might anyways make a shift to India or other suppliers, even if they were to be a bit more expensive, even if Chinese supplies might to resume, because they might appreciate that certain bit of predictability, even if it comes at a higher cost.
Yeah, that's true. So we are seeing that already, right? So we have some of the API companies in our portfolio which come on the call and say we are not the most cost competitive, but we have the best service, and they are growing YOY. So that tells you that their customers are not looking at the least cost. Their customer is looking at the best possible quality and the service that the company is providing.
Okay. This is interesting. The other last question, Aditya, and so you are a healthcare champion. You make a healthcare portfolio. Every investor doesn't need to have a complete healthcare fund, right, per se. So within those 3 or 4 pockets out there, which in pharma, which is the one according to you gives the best opportunity for risk-adjusted returns? You might have exposure to all, but they will be clearly the first amongst equals.
So I'll keep today's valuations in mind when I say this. So therefore, the statement can change 1 year down the road because the valuations might be different 1 year down the road. So in today's valuation terms, the highest pocket of conviction for me is branded generics. High cash flow, high pass-on ability to customers, high brand equity, no need to reinvest cash flows. So companies that have high exposure to branded generics are the highest conviction call. Risk-adjusted returns will be best in my view. A slightly higher risk-reward ratio will be on the hospital side, where you will get higher returns compared to branded generics, but you will have higher risk also depending on how the hospital business shapes up. And then comes diagnostic, and then comes API in that order. So API today is the highest risk, highest reward pocket, and the most stable risk reward pocket is the branded generic side. So our portfolio, the way it's segregated, we have about 45% weight in branded generics. We have about 20% weight in API. We have 20% in hospitals, and we have 5% in diagnostics. So that's how we are spread across these 4. If that gives you any sense of where our conviction lies.
And unbranded generics, no matter how much risk, there is no return.
Unbranded generics, unfortunately, you can wait. See, you don't have to buy a steel stock when you see more supply in steel coming.
Yeah,
you can wait that out. You don't need to have everything in your portfolio.
Got it. Aditya, this was really insightful. So thank you so much, firstly, for sparing such a long time in talking to us. I'm sure everybody benefits out of this. And I know we don't do too many conversations too often, but it's worth it this way. Maybe sometime to the end of the year or otherwise, if there are meaningful changes in the landscape, would love to do a conversation with you on how do you see the landscape then for 2023.
Done. Let's do that.
Great. Thank you so much for your time today, and viewers, I hope you benefited. I really enjoyed this conversation. I hope you did too. Thanks so much for tuning in.